Hey everyone, back again with another video. Today we're going to go over how loan officers like myself qualify applicants for a mortgage. We're going to see that there is a lot to it, but we're going to kind of break it down on a very surface level to allow you guys to have a better understanding. So before you even talk to your mortgage broker or your loan officer, you're going to have a really good understanding of what they're going to look for and why they're going to look for it. Matt McDonald, Premier Mortgage Lending. Let's start this up. Alright guys, so the three biggest things that we're going to look for are, number one is going to be your credit. Okay, your credit score, credit worthiness, your debt. We're going to go into all of that later, but just so you know, credit, number one. Number two is going to be your income. Obviously, we have to make sure that you have verified income to get a loan. You know, that seems fairly obvious, but again, that's the second most important thing. Number three is going to be your assets. We need to make sure that you actually have the money for your down payment and your closing costs to actually be able to afford the house and to afford the closing of the loan. Okay, so like I said before, credit is going to break out into a few things. Credit means your debt. So anything that pops up on a credit report. So we don't look at like your heating bill and your rent and your car insurance. We don't take that into account. What we take into account is anything that pops up on your credit report. So car payments, credit cards, student loans, other mortgages that you may have, personal loans, everything like that. Again, any loan or debt that you take out, not your grocery bill or monthly expenses. The other thing we're going to look for with credit, which may seem obvious, but is the credit score itself. So those are the two things that we take when we pull your credit. That's why we have to pull it to begin with. Okay, for income, we are looking at, can we verify the income? So when I say can we verify it, do you have pay stubs? And do you have your W-2s? If you're self-employed, we'll need tax returns, but that's a whole nother conversation. Okay, the other thing we're looking for with income is can we actually use the income that you have? Okay, so again, can we actually use? And that might seem weird, but there are guidelines for certain ways that you're paid. So for instance, if you're an hourly employee and you do not continuously work 40 hours a week, we have to average your income over at least a 12-month span. Okay, you're considered a variable income employee, so if you just got a raise, it may not actually be able to be effective on the mortgage application because we have to average your last 12 months. If you work 40 hours a week continuously, then we don't have to average. Just things like that. If you're salaried, we just take your salary, but again, we have to make sure we can actually use the income. What are some instances that we can't use income? We can't use income if you're a commissioned employee and you've been working for less than a year. If you're self-employed and you've been in business or self-employed for less than 2 years. And if you are a part-time employee, we need to have at least 2 years of employment for that. You can't just start a part-time job and then be able to use it. The same format goes for overtime and bonuses as well. Okay, we have to average 2 years of overtime and bonus, so we have had to have had that for at least 2 years. So again, just another thing worth noting there. And lastly is assets. Okay, we need to see your bank statements in order to verify that you have the money. If you're going to pull money out of your retirement, that's perfectly fine. We just need to see the retirement statement. If you're going to get a gift, tell your loan officer right at the beginning so that way he or she knows and that they can start getting the gift letter set up and taking that into account for your down payment. So how we use all of these together is a few ways. The first thing is we take your income and your debt and we use a formula called debt to income ratio. Okay, that is exactly how it sounds. We take your monthly debt obligations and divide it by your income. So with your new proposed mortgage, if you have $3,000 a month in debt and you make $6,000 a month, so $72,000 a year, your debt to income ratio is 50%. Okay, for a conventional loan, we have to keep that under 45%. For an FHA loan, we have to keep it ideally under 56%. Okay, there are special circumstances where you could potentially go a little bit higher for the conventional, but you need assets. You need to make sure your credit score is a little bit higher than 720. So not everyone falls in that category. So again, if you're doing the calculation at home, 45% conventional, 56% for FHA. Also for your income, it's good to note that we take your gross income. So your before tax pay. We do not take your after tax. So a lot of people get that confused when they're doing the ratios at home. They're like, how can I even afford to buy a house with these ratios? We take your before tax. So again, if you make 72 grand a year, we take $6,000 a month. We don't take the taxes into consideration for that. Another thing that we look at is the housing expense ratio. Okay, so very simply put, what is your new proposed mortgage? So if you're buying a house and the mortgage is $2,000 a month, we need to make sure, ideally, for conventional, really we want that under about 40%. There's no strict guideline to it, but again, once you get over 40, they generally want to see good credit, that you have the money for reserves, so extra assets in your banks or in your bank statements. And then for FHA, it's really under 46%. Okay, so again, 40% for conventional ideally, 46 for FHA. FHA really is a hard stop there. They won't let you go over that because they're already letting you go to 56% on your back end. So again, kind of how we use all this into the equation with our credit, going back to credit. Ideally, our credit score is over 620. Okay, that's a very vague number, but for 620, that means that we can essentially qualify for every single loan without having to provide other documentation or needing extra qualification standards. Like again, a little bit more money for reserves or maybe just a little bit lower debt to income ratio. If you're over 620, you can get a loan. That doesn't mean you're going to be in a conventional loan, but you can at least get into a loan program. Okay, with this, again, if you technically do have at least a 600 here at Premier Mortgage Lending, we can get you into an FHA loan with that, but the interest rates are going to be higher. And again, you're probably going to need to show us that you have 3 to 6 months extra of reserves on that mortgage. So if you have a $2,000 mortgage payment, we would need to see at least 6 to 12 grand after your closing costs and down payment to be able to qualify you for that loan. So really, if you are in that category, you're probably better off spending that money, if you have it, paying down debt in credit cards in order to get that credit score above 620. One more thing to note with credit is it's not that the lenders or the banks don't care if you've missed payments on your car loan or your medical bills or personal loans, but they care way more if you've missed or you are late on your mortgage payments in the past. So just because you maybe have a 30-day late on your car loan or even a 60-day late on your car loan, do not think you can't buy a house, because you more likely than not can. Even if you have collections, FHA allows up to a certain limit for collections, and they actually have formulas for us to add that debt into that debt to income ratio that we were talking about before. So just because you have maybe some stuff that you're not very proud of on your credit report, don't think you can't buy a house. Okay, we can work around it. There's always ways, or there's usually ways to maneuver around those things on your report. If you don't have a perfect report, don't stress, we'll be able to help you. And that's really it, guys. That's the very surface level of how we qualify you for a mortgage. Again, we need to see that you're credit worthy. We need to see the amount of monthly debt that you have. Okay, we need to verify your income, make sure that we have income that we can actually use and can be verified. And we need to make sure that you have the money in either bank accounts, retirement accounts, stocks, anything like that to be able to close on the loan. Okay, if you guys have any questions at all, please reach out to me. Number is 603-475-5471. I'd love to help you out, even if it's just talking about buying 6, 12, 18 months from now. Let's get you on the path, and let's get you into your house sooner rather than later.